Warren Buffett is arguably the most successful investor of all time. Many people look to him for financial advice and wisdom. In this video, we will take a look at some of the investing wisdom passed down from Warren Buffett and how to make smart financial decisions. We will cover investment principles, asset value over time, strategies for investing successfully, and the habits of successful people to achieve financial goals. Whether you are a novice investor or a seasoned expert, this video will give you the insight you need to make smart investment. So let's get started. Warren Buffett's investment principles. Warren Buffett is one of the world's richest men, and his cumulative returns have exceeded the S&P 500 average by a rate of 20%. By following his core principles, Buffett has become one of the world's wealthiest investors. We'll take a look at some of these principles and how they've helped him amass his fortune. First and foremost, Buffett believes that cash is never a good investment. He believes that it should always be invested in productive assets, such as stocks or bonds, which will provide you with returns on investment or ROI above the rate of inflation. This principle has helped him amass his incredible wealth over the years.
Cash is never a good investment.
This is something that goes with your philosophy today. Get out of cash and get into assets, because we don't know what's going to happen to the dollar.
Well, cash is always a bad investment. I mean, when people said cash is king a year ago, I mean, that's crazy. I mean, cash wasn't producing anything, and it was sure to go down in value over time.
Buffett also focuses on diversifying investments with both short-term and long-term production opportunities. This way, he's able to protect himself from market swings and maintain overall portfolio stability. Additionally, he advises against investing in something you don't understand. Research potential investments thoroughly before committing funds.
Number 3, stay in your circle of competence.
Defining your circle of competence is the most important aspect of investing. It's not how important, how large your circle is. You don't have to be an expert on everything. But knowing where the perimeter of that circle of what you know and what you don't know is, and staying inside of it, is all important. Tom Watson Sr., who started IBM, said in his book, he said, "I'm no genius," he said, "but I'm smart in spots, and I stay around those spots." And you know, that is the key.
Buffett's third principle is also important. Never invest in something you don't understand. By doing this, you're reducing your risk while maximizing your potential for gains. Finally, Buffett advocates utilizing leverage when assessing risk and taking advantage of downturns by investing in companies with high debt to equity ratios or other types of leverage instruments. Doing so can magnify your gains even further. And last but not least, while many investors focus on short-term market movements during volatile periods, Buffett stresses patience and recommends remaining focused on long-term asset value even if prices fluctuate rapidly over short periods of time. This philosophy has helped him weather some tough markets over the years and maintain total portfolio stability along the way. Investment planning. Assessing asset value over time. Investment planning is an important process that should be undertaken each and every year. Over the course of 1 year, asset values can change dramatically, and it's difficult to predict what will happen. When making an investment decision, it is important to take into account what the asset will deliver over time. By doing this, you will be able to make a rational calculation that reflects your expectations for the future. It is also important to remain within your circle of competence when evaluating companies. This means understanding what you know and don't know about a company before making a decision about whether or not to invest in them. By doing this, you can make sound decisions that will benefit both yourself and your investments in the long run. Finally, by understanding how companies are valued on paper versus how much they are actually selling for, you can make an informed decision about whether or not purchasing said company would be beneficial for your future income streams and investment goals. Strategies for investing successfully. When it comes to investing, it's important to look at the business first and then the price. This is because we want to make sure that we're doing our due diligence before investing our hard-earned money. After we have evaluated the business, we should then look at the price of the stock and decide whether or not it's a good investment. When making this decision, we should be aware of opportunities that arise and take advantage of them while they're available. It's also important to remember that when investing in stocks, it's always a good idea to play big. This means avoiding wasting opportunities during bull markets in stocks by only investing what you can afford to lose. By playing smart and seizing opportunities when they arise, you'll be on your way to financial success. In addition, by investing in yourself through education or training, you can improve your skills, which will result in an increase in your assets. Not only will this improve your financial situation, but it will also give you more power and control over your life.
Develop the habits. You've got the brain power, you've got the energy, but develop the habits of success and look around you at the people that you admire, and list what makes you admire them compared to somebody else that looks equally strong or equally talented. And those are things that you can do. I mean, just write them down. And people like people that they like them if they're humorous, if they're friendly, if they give credit to the other fellow. I mean, and they don't like them if they're stingy, or they overstate and overpromise and all those sort of things. Well, that's a decision you make. So I encourage everybody to build your own moat around yourself.
Develop habits of successful people to achieve financial goals. To become like successful people, you first need to identify their habits. Look at things that they do consistently and try to emulate them. For example, successful people are usually organized, so be organized too. They also don't give up easily, so don't give up on your goals easily either. They also know how to make decisions quickly and efficiently, so learn how to do that too. And finally, they know how to portray themselves in a positive light, which is important for any job or career you may want in the future. Start building those success habits today. To sum things up, the wisdom of Warren Buffett has been highly sought after for years. By following his advice, you can make smart financial decisions that will set you up for success in the long run. Investing in productive assets, diversifying investments, understanding what you're investing in, and leveraging downturns are essential principles that have helped him become one of the wealthiest investors around. Additionally, assessing asset value over time and understanding how to play big during bull markets will help improve your financial situation and increase your assets. Lastly, developing habits of successful people is key to achieving your financial goals, so take action on them today. Take charge of your future now by utilizing Warren Buffett's investing wisdom to make smart financial decisions. Start investing today and see where it takes you.